Joining us now, Jeremy Siegel, chief economist at WisdomTree and professor emeritus of finance at University of Pennsylvania's Wharton School of Business. Good to see you, Jeremy. We have had guys like Kevin Warsh will mention tariff inflation. He'll say tariffs aren't what causes inflation. Never has been, never will be. Inflation is caused by an out-of-control money supply or too much stimulus in a supply-constrained world. And in your view and what you're saying here, they're taxes, tariffs. Taxes are consumption tax actually can cause growth to slow, which just adds to the concerns about the other side of the mandate, and that is a full labor force.
Yeah. You said it very well, Joe. I mean, it's a tax, and I know of no good economic model that says, you know, when a government imposes a tax, they should tighten monetary policy. I mean, whether the flow through of inflation from tariffs is 20%, 40, 60, or 80 is really beside the point. I mean, I do think there's going to be a point, maybe a 1.5 bump in the CPI. It's going to be a one-time, but that doesn't mean the Fed should tighten for that. That does not call for a tightening. I mean, the money supply is increasing actually slower than it should. There's no other signs of inflation going on. So I think this whole idea, do we see the tariffs in the data? Everyone's saying, do we see it yet? Like, if we see it, the Fed should tighten is really just totally barking up the wrong tree and beside the point. And this idea about going into inflationary expectations is just also, I think, extremely misguided. You know, with all the mainstream media hysteria that hit in April and May, you know, we really had the one-year inflation expectations at 7.1% that I saw at the University of Michigan. I said, where did that come from? I said, not even the most pessimistic economists predicted that. And now it's coming down because people say, yeah, that was crazy. But what did that do to the market? Did that cause inflation? Did that cause anything bad? So this idea that it's filtering into expectations that's harming the economy is just not present in the data. My feeling is, you know, earlier on, you were talking about how important this meeting is on Jackson Hole. This is by far Jay Powell's most important talk at Jackson Hole. And in my opinion, if he just says, oh, we're going to wait and see, we have data on both sides, I think the market's going to take it very badly. I think that Jeremy, they really want him to say the data is telling us we really should begin our cutting process.
Maybe we don't have stag or inflation. Maybe the Fed should just stand pat. I mean, are you convinced that the labor market is weakening right now? Because if we don't have a stag, if we don't have a slowdown, there might not be any reason to cut. I mean, I could see that. But do you think that those revisions we saw, did that change your viewpoint of, let's say, the last quarter of labor market statistics? Are we like at 30,000 a month or something? Are we that bad?
Well, I know. Yeah, I mean, actually, I know. I was pretty surprised. Goldman Sachs does some good analysis of what they think is the underlying rate. They actually said that it's down to 30. I don't think it's quite that low, but just the stop of the illegal immigration. Most economists say that has cut the rate of job growth. From maybe 250,000 down to 100,000. And maybe it's at a slower rate right now than it would. You would expect that to happen. The first half GDP, was really just a little over 1%. We did have a better second quarter than a first quarter. I think we're going to have some slowdown. This is a consumption tax. This is a tariff tax. It is bringing in revenue. It did allow the big, beautiful bill to lower some other taxes. So there is some stimulus on that other side. We could get some trade off of the deals that are made. Now, as you know, I'm not a tariff fan. I think that if we were going to do a consumption tax, which I'm in favor of, we should have done it much more across the board than we do just on foreign imports. Nonetheless, there is that other side, and very few economists are predicting a recession. A one-time slowdown, a bit of that slowdown, a little bump, but right now, just with this, going down to 100,000 or 50,000, or GDP temporarily 1.5% does call for lower rates. Listen, the short-term rate should be 100 basis points below the 10-year rate. And right now we're at 4.3, 4.25 on the 10-year, and that means we should be moving to the low threes on Fed funds. And that's really going to help Main Street. It's going to help those small firms. We see the Russell 2000 so responsive now to whether there's going to be a cut or not, because it's exactly those small firms that are borrowing short. Not the Mag 7, not the big firms. So you want to stimulate the economy, that's where you start. Lowering that short rate, and I think there's really good cause for us to begin to do that.
August and September historically aren't great. Do you think we're in for a pause here, or
I think there will be a pause if Powell doesn't show flexibility, and then there's going to be what Trump's reaction is going to be, and then we could see a lot of fireworks, and really the naming of a Fed chair. Earlier on I said, at this point, if he's too late, and there might be signs he was way too late on the inflation. Boy, I mean, that criticism is going to come in, and his credibility is going to be down. And a shadow chair is a very difficult situation to have. So, in my opinion, the data supports lowering rates, and my feeling is that I hope to hear that Friday morning.
I mean, fighting the last battle is never a good idea, and that's why they're so sensitive about inflation and being, letting the cat, not burying it completely, and because they got so much grief, and maybe rightly so, considering what it did to, real wages and everything else when we got to 40-year highs. But I've learned from betting. Whenever I bet on a team and they just are the worst, and then next time I'm betting, it's like I remember how bad they were, and I bet on the other team, and then that team always wins because fighting yesterday's battle that never works, and I think that's what they're doing right. But I'm not convinced they should do. Things might be where we're not inflationary or heading into a slowdown. That's also a problem. Everybody says stagflation. Maybe we got neither. Maybe things are sort of okay. That's possible.
Yeah, well, I mean, stagflation is a persistent. I mean, in the 1970s, we had unemployment kept on rising. We had inflation of, 8 to 10%.
Yeah,
for nearly 14% on that is true stagflation.
We had a misery index, Jeremy, of like over 20.
Yeah.
Remember?
I mean, we are just nowhere now. So, people who say, oh, my God, it's stagflation. If we have, let's say we have a 1.5% one-time bump from this tax, and we have, maybe for 1 year we have a slowdown of GDP from what it could be, 2.5% down to 1%. That's not the biggest disaster in the world. If we open up the rest of our economy, if we look forward to what AI could do to productivity, that is not going to be the major mover going onward. But I think, at this particular point, we are the only major country that has not lowered their rates, and we should be looking beyond any bump on this tariff.
Okay.